real estate investing actually allows you to do a number of things as an investor that other investments just don't offer you. Depreciation is, in a sense, in a simple way, the loss of value of an item that you purchased. But the fact that depreciation is basically recognizing that something loses value on the books. And the crazy thing for a real estate investor is that the value of the property loses the same like the laptop. Even though in reality, in real life, that house is now significantly worth more than what you paid for it. Welcome to the Ideal Wealth Grower channel. My name is Axel Meyerhofer. I'm the founder of Ideal Wealth Grower and your host for this episode today. When we're talking about real estate investing and generating passive income, a lot of people ask the question, what is actually the difference between investing in real estate, especially in residential real estate like we are proposing, versus other investments? And one of the really big differences that you will find is that real estate investing actually allows you to do a number of things as an investor that other investments just don't offer you. So what are some of those things? And I want to focus today specifically on the term depreciation. Now, you may have heard about this, but it's not necessarily always very clear what it really means and how it really relates. So what is depreciation and how can you benefit from it? If you think about it, depreciation is, in a sense, in a simple way, the loss of value of an item that you purchased. So to make this a little bit more practical and a little bit more applicable for you in the context of real estate investing, I want to take you through a little comparison, or you could call it a case study. And we have to go back a little bit in history to make this work and to make this make sense. So when computers came out, they were first these huge mainframe machines that occupied a whole big room. And then the next thing were people that you have heard about, like Steve Jobs, Bill Gates, Wozniak, names like that. What they became famous for was that they said, we want to get computers smaller. And so they called those personal computers, and first we had desktops and then we had laptops. So if you go back to 1995, 25 years ago, the first laptops came out, and like anything that is new and high-tech and not really been around that much, it's very expensive. So the first laptops cost $5,000. And if you buy one, then you have this expense of $5,000. And if you buy it as a business, then you are allowed by the tax code to tell the government, the IRS, that you purchased this laptop for $5,000 and that you actually have a cost of using this laptop over time. Now, in comparison, let's say in 1995, you had the opportunity to find a small little property somewhere in the Midwest that needed to be updated and upgraded, and you could buy this property for, let's say, $45,000, and you put $5,000 of your own money in to buy this property and then move in and fix it up. So you put about 10% in, not quite 10% in, with all the costs and stuff like that. Your $5,000 was basically around 10% of the purchase price of this house that you fixed. And on the other hand, another person bought a $5,000 laptop. Now, when each person files taxes, the business owner who bought the laptop says, I had the laptop now for 1 year, and it's not the same value anymore. If I wanted to sell it, it wouldn't give me the $5,000 back, I get less back. And that difference in how much would you get realistically after a year, 2 years, 3 years, 4 years, versus what you paid when it was new, is called depreciation. It's kind of like you have probably heard the similar story when you buy a new car and you drive it off the lot and it immediately wouldn't be the same price anymore if you turned around a week later and give it back. So that's depreciation in principle. Well, what does that mean and how does that really apply in the context of real estate investing compared to our laptop example? If you really bought that laptop in 1995, 25 years ago, and you still had it and you were to put it on eBay, what do you think you get? $5, maybe $10? Maybe somebody wants to give you $20 or $30 because they kind of like to have an old laptop. But it's really not functional anymore. You can't do anything with it anymore. You couldn't download any software on it anymore. It's super, super slow. So it really has outlived its time and its usefulness, and that's why the government says, well, that makes sense. A 25-year-old laptop is not worth anything anymore, so the value officially is zero. Now let's look at our house. We bought that house, put $5,000 in, bought a $45,000 house. 25 years later, it would be completely realistic, nothing out of the ordinary for that house to, if you wanted to sell it, or a similar house in the same location to buy it, it would be now probably right around $100,000. But what does that mean for you on taxes? Every year that you owned that house, the same way like the person who owned that laptop, you write off a little bit of the value of the laptop and the value of the house called depreciation. So here we are in 2020, the laptop on the books has a value of zero and the house on the books has a value of zero. The big difference is if you go out, maybe not on eBay, but let's say on Craigslist or some other place, some Zillow website or so forth, and you put up your house, your $5,000 investment that got you the house, which is, by the way, almost paid off, because if you got a 30-year mortgage and we are 25 years in, it's probably almost paid off. You could sell it now for $100,000. The laptop, you're lucky if you get $5, $10, maybe $50. So from a tax perspective, the laptop and the house are treated equally. They both depreciate the same way, and the rules in the United States say 27.5 years for something like that is how long it takes for a house to depreciate. Items like a laptop, most people would say depreciate probably to zero within like 5 or 6 years. But the fact that depreciation is basically recognizing that something loses value on the books. And the crazy thing for a real estate investor is that the value of the property loses the same like the laptop. Even though in reality, in real life, that house is now significantly worth more than what you paid for it. So that's the big difference. And if you were to go and now say, okay, I want to sell this house, then the difference between those $5,000 and your sales price, let's say you got $100,000, you could keep those $95,000 as your profit from the sale of the house. And oh, by the way, you could also keep the $5 or $10 or $50 you get for the laptop. So depreciation is an important concept to understand, and most people think, well, I know by my gut feeling that the house or real estate is increasing in value, but the laptop wouldn't. But when it comes to taxes and to depreciation and how the government is actually treating those two, it's the same. And you want to know this because now when we say, let's compare this to other investments, of course you wouldn't consider a laptop an investment. But if you say, so, okay, I understand what depreciation is, so now how does real estate investing compare to investing in other things like stocks, for example? For number one, you cannot buy the stocks for just 10% down like you bought the house. And for number two, if you were able to get those things for the same price, your stocks don't depreciate. And there's no such thing like depreciation. So because of that, it is much, much more expensive to own stocks. If you don't do anything else, if you just look at what does it mean from a tax perspective, than real estate, because you can depreciate real estate in 27.5 years. And even though that sounds very long, you do it every year a little bit on your tax return. So I hope you learned a little bit what depreciation means. If you like these kind of videos, I want to invite you to subscribe to our channel. Hit the like button, because that tells the YouTube algorithm that you like this video and that you watch this video all the way to this point. And if you want to get notified whenever we come out with these videos or other videos, then please ring the little bell notification so that you automatically get notified when we have a new video. The last thing I want to mention is, if you go to our website and put in idealwealthgrower.com/free, you will get access to a free mindset manual that is a pretty substantial document that we created to help you to get into the frame of mind of a real estate investor who really wants to take advantage of these different things that the government has put out for real estate investors. And depreciation, as we discussed today, is one of those things that really give real estate investing a huge advantage and allow you to build income over time, so you don't need to exchange time for money anymore, don't need to go to work, and still have income coming in from your properties. So with that, I wish you all the best, be well and be safe, and see you in the next episode.